Hello and greetings everyone. I hope everybody's having a fantastic day today. In this video today, we want to look at a scenario where Bitcoin is using its volume efficiently to draw in scarcity through burning tokens, to retain liquidity, and to give back to the community through staking platform. This is the best way to explain what the Bullrun ecosystem is all about, is to always make real-world examples of what we have and what we know best, and just add a scenario where Bitcoin would be applying our fundamentals as far as tokenomics are concerned. Needless to say, Bitcoin is the largest cryptocurrency in the space. Right now, close to 44,000 in price. It has more than 50% of the total market cap of the entire crypto industry. So it plays a major role. It has major weights. If we look at some key points that sets Bitcoin apart, by design, it has a limited supply of 21 million. So far, roughly 19 million have already been mined, putting it right over 80% of all Bitcoins that will ever exist are already in circulation right now. The other pros of Bitcoin is that it's built with a distributed digital ledger technology called blockchain. It's a public ledger of a recording system, and it records transactions related to data in multiple places at a time. Its blockchain is designed to make it extremely difficult to hack the system or forge the data that is stored on it, thereby making it very secure and immutable. So each computer in a blockchain network has a copy of the ledger. This prevents a single point of failure. These are all the pros, the great things that Bitcoin really carries along. So other strengths of Bitcoin, of course, are it's the most widely accepted cryptocurrency in the space. Its limited supply, its divisibility because it's digital, its transportability, of course, and durability, and it cannot be easily counterfeited. These are the following traits. Like we said, it has a limited supply of 21 million, and the best part, it is protected against possible counterfeits by means of the blockchain and cryptographic keys, of course. So these are the strengths that we want to highlight that Bitcoin has, of course, and also other cryptocurrencies, of course, have similar traits, since it's also using the blockchain technology. But now we would like to also look at some challenges that the entire industry is suffering. Keep in mind, this video is just to draw a picture of what it will look like if Bitcoin was fully using its volume to bring in scarcity of tokens, retain liquidity, and give back to its community, to the holders and stakers in the form of staking distributions. What would it look like? So, of course, keep in mind this is theory. Bitcoin is a proof of work, so it's not a proof of stake. You can't stake Bitcoin. It's just theoretical, just to have an idea of what it would look like. And there's a reason why we're doing this. So once more, let's zoom out and get a better idea of the market. So cryptocurrency failed in the test of digital money. This comes from the Monetary Authority of Singapore. In their opinion, cryptocurrencies have failed the test of digital money because they have performed poorly as a medium of exchange and a store of value. Their prices are subject to sharp speculative swings, and many investors in cryptocurrency have suffered significant losses. So this is the argument, and this is why they say that in the test of digital money, cryptocurrencies have failed. That's why they're all about stablecoins, and not cryptocurrencies will be part of a financial ecosystem in the future. Now, let's break down what constitutes a medium of exchange. Like the article suggested, stablecoins. The way you become a medium of exchange is through stability. Stability is achieved if you retain liquidity. Liquidity dictates and removes the sharp volatility. If you have deep liquidity, the volatility reduces. Also, that paired with deflationary mechanisms, that combined brings strong and solid stability, because what you do is you have deep liquidity that brings stability, and you add deflationary mechanisms to it, meaning that you have a binding mechanisms adding to it. It really brings stability into it, and with those two features combined, you can really bring a lot of stability, and that goes hand in hand with store of value. Now, what constitutes a store of value? Store of value, that means you have to be scarce. There must be some scarcity, and this is why Bitcoin is considered a store of value, because it has a limited supply of 21 million, like we just discussed. However, currently it is still inflationary, and if we look at here, it's estimated that all Bitcoins will be mined by the year 2140, at which point the last block reward will be released. So needless to say, till that date, Bitcoin will remain inflationary. However, every 4 years, the last halving occurred in May 2020, and the next one is expected to occur in 2024, this year, in 3 months now from here. Every 4 years from now, the inflation rate will be in half. Currently, since 2020, every block gives out 6.25 Bitcoins. With this upcoming Bitcoin halving, it will halve this number again, 3.125 Bitcoins per block, and it will continue like that until 2140, when the last Bitcoin will be mined. Anyway, that's just to show that Bitcoin is still inflationary. So this is why we want to really look at this aspect. What if Bitcoin was deflationary and scarce? And using its volume that it has, if we look at Bitcoin, it's the highest traded cryptocurrency in the space at 22.7 billion on a day with daily volume. What if Bitcoin would be using this high volume efficiently to bring in deflationary aspects by burning tokens and causing scarcity, by retaining liquidity, and by incentivizing its holders through USDC distributions? Let's look at this closely. To do this, let's look at the 3 challenges that the market is facing. Currently, the market is facing 3 challenges. The first one is the liquidity crisis. Secondly is the inflationary crisis. And finally, the inefficiency that these cryptocurrencies have as far as their volume. They're not using the volume efficiently. It's not coded within the smart contracts for these cryptocurrencies to be using the volume efficiently. So these are the 3 challenges we're facing in the space right now. Like we first saw, the biggest issue is liquidity issue. So Bitcoin has been in a liquidity crisis for a very long time, and that has been something that is plaguing the space. As we know, Bitcoin holds over half the entire total market cap of the cryptocurrency industry. So whatever Bitcoin does, it affects the entire industry as well. So liquidity crisis is something major that has been plaguing this industry. Unfortunately, it's not a popular topic to be discussed. Another thing to really pinpoint is there is something called liquidity to market cap ratio. The way you calculate that is you take the total liquidity and you divide that by the total market cap. You get a number between 0 and 100. Closer it is to 0, the more liquid it is, and the closer it is to 100, the deeper the liquidity. So preferably you want anything closer to 100. That will just assure that in case of a bank run, there'll be enough liquidity for the holders of the token to still be able to exit their positions. If we do the math for Bitcoin, we see that the number is sitting at 0.1%. So this is the liquidity to market cap ratio, is 0.1%. This is pathetic. It's extremely low. And this just reflects the fact that Bitcoin's liquidity has been really suffering, and this is a serious issue in the space. This is why, as an industry, we need to really focus heavily on using this blockchain technology to find ways how we can retain the liquidity that is about to enter the space, especially now knowing that 2024 is the year where we have major catalysts ahead of us. Let's start with the first one. Of course, the obvious one is Bitcoin halving. This will cause Bitcoin to really experience a price squeeze. Another catalyst that we see here is the interest rate cuts. The government say that at least this year they're thinking of cutting it at least twice, if not 3 times. This, of course, will bring a lot of liquidity into the market. We know it's election year, and based on Forbes, it will be the biggest election year yet. And we all know that election years are always vital, because this is where the politicians want to stand out and set themselves apart, be elected or re-elected, and they'll do anything in their power to ensure that the markets are booming again. Also, of course, the Bitcoin ETFs, we are still waiting for the approvals. Now with Goldman Sachs also jumping on, they want to be part of BlackRock's and Grayscale's Bitcoin ETFs. They want to play up the role of authorized participants, because asset managers cannot directly purchase Bitcoin. They're using so-called authorized participants, which are usually large banks such as JP Morgan that they're already using, and now Goldman Sachs also wants to be part of it, and then JP Morgan and Goldman Sachs would then purchase Bitcoin on their behalf. So that's what an authorized participants mean. The authorized participants are the gatekeepers. They play the major role of providing liquidity and dictating how many ETF shares will be issued or removed from the market. And of course, finally, tokenization. Larry Fink through BlackRock, they being the largest asset managers, of course, they lay major emphasis in tokenizing assets, and they've been doing that already using JP Morgan's private blockchain, tokenizing their money market funds and collateralizing them to gain more liquidity to purchase assets, digital assets. So this is a new instrument, digital instrument that they want to offer to their clients. This is why they're so keen on jumping on the bandwagon and joining the blockchain technology, because it opens doors to so many more possibilities. This will be a topic for another video. Today we are focusing on what would Bitcoin be like if it had the functionalities of our ecosystem, if it was retaining liquidity, if it was burning tokens, and if it was giving out distributions to its community, and doing all this using its high daily volume that it has, because the whole idea is that the market is so inefficient. Cryptocurrencies are very inefficient, and we're not picking on Bitcoin. Of course, same goes for so-called blue chip utility tokens such as Lido, Maker, Aave, Uniswap, and so on and so forth. If we look at them, we see the same thing. For example, Uniswap has a daily volume of 135 million. However, this volume is inefficiently used. It's not used to retain liquidity, be scarce, cause scarcity, or even give back to the community. So this is what we mean when we talk about market inefficiencies that we experience in the crypto space. Similar with Aave, it has a daily volume of 175 million. Right now it jumped to 178 million, close to 179 million on a daily basis. However, it's very inefficient with its volume. And this is one of the three major crises that we face in this industry: liquidity crisis, inflation, and inefficiency in the use of the volume. So inflation is what makes these tokens look like this. They go all the way down, and this is what Bitcoin did right. To avoid all this inflation, Bitcoin decided to cap its supply to 21 million, and also every 4 years cut down the inflation rate in half. So inflation is very rampant, and this inflation, especially by these stakeable tokens using proof of stake consensus, they're the ones that are really causing a lot of damage for the token itself, because they keep issuing more and more of their native tokens as staking distributions, and the stakers eventually they'll want to take their profits. Once they do so, it causes a negative effect on the price, as you see, despite the high volume, daily volume of the token. And this is very inefficient for the market, because the tokenomics and the fundamentals are extremely weak. They don't take full advantage of the volume. They're inefficiently using the volume that they have. They're inflationary, and they're not retaining liquidity either. Now that we've seen the challenges within the space, within the industry, and it's not limited to Bitcoin alone, this is an industry-wide issue, and we looked at a few of other blue chip utility tokens that are experiencing the same issue, and we've looked at the liquidity to market cap ratio of Bitcoin. We saw that it's at 0.1%, meaning that it's very liquid. We saw articles talking about this in detail. This is not a popular topic, or many of these mainstream YouTube channels are not going to discuss this, or maybe they're not even aware of this, but it's important for us to understand this crisis that we're experiencing. So with all this said, let's look at our ecosystem. Our ecosystem was built based on these three challenges. We came with a solution while we were developing this ecosystem. We wanted to build something that is sustainable. How do you become sustainable? First of all, if you take advantage of the volume that you're using, use the volume, because volume comes with global adoption and a large community. This is what causes the volume. So once you have such a volume, you need to be efficient with it. The Bullrun ecosystem was from day one developed to take full advantage of that volume. This will keep the ecosystem sustainable, because it's driven by volume and not by just minting more or issuing more native tokens that will inflate the token and cause the chart to look like this. This is not good for the token, whether for the token holders. So what we decided to do is to have mechanisms in place where we retain liquidity, we ban tokens causing scarcity, and we give back to the community through USDC distributions. All of this is captured through the volume, and volume is what is not being effectively and efficiently used by these cryptocurrencies in the space. We saw it with Bitcoin, we saw it with Aave right here, and we also saw it here with Uniswap. And with Curve, it's just a nightmare, because due to inflation, Curve lost, since its all-time high, 99% of its value. This is all due to inflation, weak tokenomics, weak fundamentals. For those that are not familiar with Curve is a liquidity and staking platform, and once you stake their tokens, you get even more of their native tokens, and obviously in the long term this will cause inflation, and it will cause the chart to look like this, and the price of Curve will still keep reducing even though it has such high volume, daily volume at close to 57 million on a daily basis. So this hopefully paints a picture for you to understand, community, that these three challenges are plaguing this industry: liquidity crisis, inflationary crisis, and the inefficient use of the trading volume. Now that we have that in mind, like we said, we developed the Bullrun ecosystem to have mechanisms in place, hard-coded in the smart contract, to be able to effectively use the volume to retain liquidity, to burn tokens and bring scarcity, and to give back to the community through USDC distributions. Let's go through it one by one. Liquidity is retained with volume. We have three ways to retain liquidity. The obvious way is through the taxes. 6 on the buy, 6 on the sell side. So 3% of the trading tax goes towards retaining liquidity. Liquidity and burning mechanisms combined bring stability, and those two items cause the token to be stable. That addresses the issue that we just mentioned at the beginning, which is a medium of exchange. And this is what the Monetary Authority of Singapore said, that cryptocurrencies perform poorly as a medium of exchange and a store of value. So let's look at the store of value aspect. How do you become a store of value? You have to be scarce, and this is why we have our burning mechanism. We also started with a supply of 1 million, and this supply, unlike Bitcoin increasing over time, our total supply is decreasing over time. Let's look at Etherscan here. We are down to 973,000 tokens so far. We've burnt more than 26,000 tokens. So we are scarce. With every trade, with every buy and sell, the Bullrun tokens become scarcer and scarcer. This addresses the issue that we saw here, that the Monetary Authority was addressing, the store of value aspect. You need to be scarce, you need to be deflationary, and you need to be retaining liquidity. So all these two mechanisms put in place, including the staking platform, puts us on the map. Why is staking so important? Let's look at it. Number one wallet is the staking wallet. So 56% of the total supply is being staked right now. So 56% of the BRL total supply, which is right now at 973,000, more than half of that is taken from the circulating supply and locked away through staking. Now, keep in mind, at the same time as trades are going on, the total supply is also being reduced with every trade. So the best comparison is this: what Bitcoin experiences every 4 years by reducing its inflation rate in half every 4 years. This, with the demand remaining the same, causes a supply squeeze and a demand so much that it causes the Bitcoin price to push up. This happens every 4 years with Bitcoin. We have a mechanism in place where this happens with every single trade. Whether it's a buy or a sell, it squeezes the price because we have a high percentage of the total supply that is staked, removed from the circulating supply. We have a reducing total supply. We started initially with 1 million. Now we are down to 973,000. And all this is sustainable because it's all driven by trading volume. Another thing with the USDC distributions, we have a smart contract which accumulates USDC tokens. And right now, as you see, with low volume, it's at 400 USDC. So it accumulates USDC using the trading volume. And this USDC goes towards those who decide to stake BRL tokens, like you see here, 545,000. And if we go to Etherscan, this is the same amount you see with the top wallet. Over 545,000 BRL tokens are staked away. And these individuals that decided to stake are taking part of this pool of USDC that is being accumulated through the trading volume. This is how our ecosystem works. So now that we've identified that Bullrun is accumulating a liquidity pool, reducing the total supply of BRL, and accumulating USDC distributions, all through volume, which makes it sustainable and scalable. Let's be fair and look at its liquidity to market cap ratio, just to show how efficient this mechanism works. So this mechanism has proven itself that it works. If we do the calculation now here to find out what's the liquidity to market cap ratio of Bullrun, we see that more than 65% liquidity to market cap ratio in comparison to the 0.1% of Bitcoin like we calculated. What does that mean? Whenever the community is ready to exit their position, there is enough liquidity in the space. So even if there is a bank run, there is enough liquidity for the individuals to exit their position. And this is with a relatively very low volume. So obviously this will only improve with time as we are picking up on steady volume. To show you another aspect with Bitcoin is there's a lot of Bitcoin billionaires, of course. A lot of people started accumulating Bitcoin early on. This blockchain technology gives room for anonymity. So a lot of people are, is anonymous. And also many have their Bitcoins in multiple different wallets. So it's hard to know who owns who owns what. However, based on the current data, we can see that they are so-called centimillionaires, meaning those with Bitcoin portfolio of 100 million and above, and there's roughly 78 of those. And we see that with only a liquidity of right below 900 million, if there would be a bank run right now, Bitcoin would drop to zero because there's just not enough liquidity right now for it. And this is the reason why we always stress on liquidity. Now that we understand all this and that we have a broader picture, let's close this session by using Bitcoin's volume and highlight what Bitcoin will be like if it had the same fundamentals, if it was using its volume efficiently and effectively to retain liquidity, bring scarcity through binding tokens, and retaining staking distributions for its holders. Let's do the math here. If we will calculate using the exact numbers of current Bitcoin volume, let's take that 22 billion, let's just keep it even, 22 billion right now. If we multiply that by 1%, we will get 220 million. So right now, 220 million, if we use our tokenomics, 1% goes to binding, 1% goes towards accumulating USDC. Like we saw here, our smart contract does, it accumulates USDC for those that decide to stake their BRL tokens. They'll receive this staking distributions consistently based on the volume. And also 3%, of course, goes towards retaining liquidity, which is added on a daily basis to the liquidity pool. Now, having these numbers in mind, let's go back to Bitcoin and see what the numbers are. So as we calculated, 1% of 22 billion is 220 million. So we saw that 1% would go towards binding tokens. Let's picture Bitcoin was to use our tokenomics. This means that 1%, which from 22 billion is 220 million. This means that 220 million worth of Bitcoin would be burnt and forever removed from the total supply on a daily basis. This same 220 million would go towards accumulation of USDC. Like we said here, we are accumulating USDC for those who decide to stake BRL. So we take 1% goes towards accumulating the USDC. So this 221 million would go towards the USDC for those who decide to stake Bitcoin. Like we said, Bitcoin cannot be staked. It's on a consensus of proof of work. But this is just theoretically, just what would happen if it had the same mechanism such as Bullrun. Now, this is 1%. Now, if we multiply this by 3, it will give us the amount that would go to the liquidity pool. So 660 million within 24 hours would go towards liquidity pool. As we saw currently, in 15 years, Bitcoin managed to amass 870 million in liquidity. So in one day alone, based on this massive volume, Bitcoin would almost double its liquidity just based on 1 day of trading volume. This is what we mean with inefficiency of the volume. And these are the three main crises that we face: the liquidity crisis, inflation, and the inefficiency of use of the volume. So I hope this video really highlighted and showed that if this large blue chip or utility tokens would have the same fundamentals such as Bullrun has, and we made an example specifically with Bitcoin, it being the largest cryptocurrency, if it had the same fundamentals like Bullrun does, we saw how it would affect Bitcoin in a very positive way, especially as far as liquidity is concerned. It will be accumulating hundreds of millions in liquidity. Actually, within one day, it will almost double its liquidity amount. it would bring scarcity to Bitcoin. We saw 220 million worth of Bitcoin will be removed from total supply forever, and another 220 million would be for USDC and given to those who decide to stake Bitcoin if it was on a proof of stake. Of course, this would cause Bitcoin holders to remain staked because they want to be part of that 220 million on a daily basis. It will strengthen and secure the network. As it's being traded, of course, it will cause a massive price squeeze like we saw, and this won't have to be every 4 years. This will be with every single trade. So it will cause scarcity. It will give back to the community by accumulating USDC distributions, and more importantly, it will retain liquidity and better their liquidity to market cap ratio from a 0.1 to eventually with this mechanism, Bitcoin would achieve a 1-to-1 liquidity to market cap ratio. This would definitely address both the medium of exchange and the store of value aspect of it, and this would single-handedly make Bitcoin be the most efficient and sought after commodity in the space. Obviously, there's no commodity like this at its form like we just explained. Bitcoin has great futures that are positive, but it also has challenges that it's not meeting. If that wasn't the case, there won't be no Ethereum, no Solana, and all other layer 2 blockchains from Ethereum. This industry is still young and it needs innovation. And those who will find out the right blueprint to create the ultimate commodity that addresses these 3 challenges that we are facing, they will win the race. And to close out this topic today, there's a good news and a bad news. The bad news is that at its current form, Bitcoin cannot be changed. Satoshi used a method in the source code to impose a hard cap, a maximum limit on Bitcoin production of 21 million. The supply of Bitcoin is replenished at a set rate like we just looked at, 1 block every 10 minutes. The system design reduced the number of new Bitcoins in each block in half every 4 years. Like we see here, the source code won't allow Bitcoin to be altered or changed. So that's the bad news. We can't alter the source code, and Bitcoin cannot be adjusted to have such strong fundamentals as far as tokenomics are concerned. But the good news is that Bullrun has the capability to be widely adopted, and with adaptation comes volume. So it is much easier for Bullrun to gain adaptation and gain that much volume than Bitcoin's source code to be altered and to have such fundamentals as far as tokenomics. What Bitcoin is missing is such strong tokenomics and fundamentals. This is impossible because the source code is built not to be altered, and the miners would not allow it. It's hard-coded in the source code and there's nothing you can alter. The good news is that Bullrun already is built from day one with such strong fundamentals, strong tokenomics that is retaining liquidity with every trade, reducing the total supply with every trade, accumulating USDC distributions for its holders and stakers with every trade. All this is written in the source code in the smart contract, and nobody can alter this. All we need now is global adaptation, and with that comes volume, and volume brings sustainability and scalability. So all the missing ingredient is volume. With volume behind Bullrun, we made an example by calculating efficient Bitcoin would have been with having such tokenomics. This is the best way to just highlight the power of the Bullrun ecosystem and how the fundamentals as far as tokenomics can add much more liquidity for Bitcoin. It would be causing even more scarcity in supply. Instead of increasing to 21 million, it would be reduced, and this would incentivize those who are holding Bitcoin to hold even more, because with this volume we'll be accumulating USDC distributions as well that will go towards those who decide to stake Bitcoin. As we know, this is all in theory because Bitcoin is under proof of work and not proof of stake. This is just to make a point on the efficiency of the Bullrun ecosystem and tokenomics, that all it needs now is global adaptation and the volume behind it, and it would be such an efficient mechanism. Again, to highlight, there is no commodity right now on the market that has both the strong fundamentals as far as tokenomics and the high volume of Bitcoin. So fusing these two together, taking the volume of Bitcoin and adding it to the strong fundamentals, tokenomics mechanism of Bullrun would put together the ultimate commodity that we so desperately need in this space. I hope this painted a better picture, and these two combined would address the challenges we face in this industry, and that is liquidity crisis, inflationary aspects, and the inefficiently used volume from these blue chip or utility tokens. Keep in mind, it's easier for Bullrun to be globally adopted and gain the volume than Bitcoin's source code to be altered. It will need to be a hard fork in order to even achieve anything close to this, which is very unlikely to happen. So in this crypto space, whoever finds the right blueprint to come up with a concept that is efficient, that is scarce, that retains liquidity, and uses full potential of the volume efficiently, they are the ones that will be the winners at the end. We already developed a platform based on those three challenges, and we have addressed them. We've proven that the concept is fully working efficiently, and now what we need is the volume and the adaptation of this ecosystem to get the maximum out of it and the full potential. We just want to highlight, inform, and educate, and just point out that right now there is no blockchain that is perfect. We are all in the early stages of this blockchain technology. We are just at the tip of the iceberg and find ways how to best create the most efficient ecosystem that is addressing these three challenges that we just discussed. And right now, we are a monopoly because it's our ecosystem in this space that is addressing these three challenges. And if you find a monopoly, keep it, hold on to it, get on it, and look at this video as your reference point. Start doing your research, jump into the rabbit hole. I hope this will help you in making your decision. As we know, this is the year of catalysts. Bitcoin halving is ahead of us. The interest rates are being cut this year multiple times. The election year is here. The Bitcoin ETFs are just days away to be approved, and the tokenization of asset classes from the real world are about to enter the space. A lot of volume and liquidity is about to enter the space. And if your ecosystem is not built from day one to retain liquidity, bring in scarcity through burning, and also give your holders incentive through distributions that are driven by volume, you will miss out on this wealth generating event of 2024. This is the video for today. I hope this was informational, educational, inspirational to you all. With this said, I want to wish you a wonderful rest of your day, and let's keep in touch.